Hello traders, welcome back to the channel. If you're watching this for the first time, show some love by subscribing, sharing the video and liking, and leave a comment section. Anything you have seen that I've done well or anything that I'm missing on these summaries. So last time we summarized on the ICT's 2022 model, both the sell and buy model. Today we want to learn about order blocks. I've summarized something about order blocks, and I won't do all of it, the whole entire topic on order block as ICT has put it. So, order blocks. What are order blocks? We have a bullish order block and we have a bearish order blocks. So, a bullish order block, the lowest candle with a down close that has the most range between open close and is near a support level. And a bearish order block is the highest candle with an up close that has the most range between the close and is near a resistance level. So the question you want to ask yourselves while backtesting to see which order blocks are being respected and which ones are not being respected is, where can you identify the support level and where can you identify the resistance level that will be viable for you to take trade off of. Okay, I will leave that to you because you will go and backtest these concepts as usual for you to get the most out of it. Hint: wait for price to give an indication that larger orders are coming into the market. There should be strong reaction toward the opposite side once price reaches an important resistance or support level. And what validates that? The order block is validated when the high of the lowest down close candle or the low of the highest up close candle is traded through by a more recently formed candle. Ideally, the best bullish order blocks will not see price trade below the midpoint or the mean threshold of the candle, or trade above the mean threshold if bearish. So how will you identify a mean threshold of an order block? You take your Fibonacci tool and you measure and mark the 50% level of that order block, the candle that makes the order block. By doing that, you don't want to see the trade going past that when it is in a bullish situation, and you don't want to see it pass that mean threshold to the top if it is a bearish order block. And if it does so, you can confidently close the trade even before it touches your stop loss, because you know what you are looking for and you know how it behaves. So the most important thing is going to backtest this concept to find how you will trade it. These are just notes that I've summarized from the ICT video. And on the displacement, the price may run away from the order block. If it's valid, often there is a strong reaction, so you need to be patient for it to retrace and retest the order block. This is an indication that there is a displacement in the marketplace. This offers an evidence in price action that there is institutional sponsorship behind the move. Hint: displacement may also leave behind another POI. POI is point of interest, the fair value gap. So you must always see the fair value as just illustrated from the 2022 ICT cell model. and buy model. So you will use this concept of order blocks, trade ICT 2022 model. And if you are already profitable trading just off FVG, now imagine how you will take classic trade and clean trades when you are trading order blocks and you have understood order blocks and you have backtested order blocks to own that scale. Okay, we are now defining our risk. When price impulsively move away from the bullish and bearish order block, if it may retrace after the displacement, which can offer a buying or selling opportunity as price return to the open of the bullish bearish order block candle. The first target, buy stops or sell stops, is your first target. You can collapse the entire trade, or you can leave half of it running and you close half of it. And stop loss, the low of the bullish order block or a high of the bearish order block is a relatively safe stop loss placement. And you want only, in my case, I only take trades which gives me a stop loss of between 20 to 30 pips. I don't take trades gives me a stop which is more than 30 pips. Okay, we have a top-down analysis and what we should be patient to observe. When the month begins, I do my trades, I do my analysis on the monthly, the daily. As the month keep on going on the second week, I focus on the weekly, daily, to where I take trades on the 1 minute, 5 minute chart. So we have a analysis on bullish top-down analysis and we have bearish top-down analysis. While doing all this, you should be patient and observe price running into discount arrays. Watch the price respect the bullish order block. After that, an impulsive move to the upside. Hint: bullish consecutive candles can be joined together to form one big candle sometimes. Like what I'm talking about, this is a real example on my charts, and you can join this and this and this one and this one because they are bullish consecutive can to form a one candle in some situation to help you with analysis instead of navigating from one time frame to another, which can be confusing sometimes, but it's always okay to navigate. This is just a hint. You will always, it will come handy when you already know what you are looking for exactly. And you should also be patient and observe the price moving to premium arrays, respecting the bearish order block, strong reaction of the bearish order block, the downside case of a bearish top-down analysis. In the topic of order blocks, we have something called mitigation blocks. And what are these mitigation blocks? What are these mitigation blocks? This short-term rally in price highlights a specific institutional reference point known as mitigation block. And a mitigation block has something called MSS. MSS is market structure shift. Once the market structure shift, your attention should be fixed on that specific low in price action. Like after it has formed market structure shift, don't hop in into trade like you think that the bus has already left you. Be patient and see it retrace back, so your focus will be at this particular point. And you should note, the above is a bearish mitigation block in description and example. The opposite of the setup is called bullish mitigation block, which operates exactly the opposite of the illustrated bearish mitigation block. And to illustrate this, as ICT puts it, this is the step-by-step process on how to wait for it and what to do next. And this is a real example of my charts and how I am possibly trading them. When price action returns to A, point of reference, long position taken from point A to B, price swing will have an opportunity to liquidate or mitigate the net loss that occurred when price dropped from B to C. This can result in new lower price swing to C for retesting, or significantly lower price in the support level under the market price. That's why we should always take a half or collapse the entire trade at point C after it retraced to this our focus point MSS, market structure shift. Then we now are in the trade right now. Then we are targeting point C. We either collapse the entire trade at point C, or we collapse half and leave the rest moving to the next sell stops. Yeah. We also have something called rejection blocks. And what are rejection blocks? So to illustrate it in an easy way, this is how it works. So this is a bullish order block, and sellers came into the market. Sellers came into market and pushed this to the downside, leaving a huge wick here. That wick, we can put an imaginary candle block here, which is a bearish candle, right? So this is called bearish rejection block. The prices were rejected. The bearish rejection block is when price high has formed with the long wicks on the high of the candle, and price reaches up above the body of the candle to run buy stop liquidity before price rallies lower. It runs the buy stop liquidity before it rallies lower. That's where I take trades of the strategy called turtle soup sell, turtle soup buy. So if you're keen enough, you see these buy stop, and this candle here comes and rallied up to take the buy stop, and after that the prices rallies down. We target our first sell stop C. And a bullish rejection block is when price has formed with the long wicks on the lower of the candles, and price reaches down below the body of the candles to sell side liquidity before price rallies higher. An example is here. The price action comes and takes sell side liquidity. Then after that it rallies up. That's why I always prefer putting my stop loss 20 to 30 pips lower or higher, depending on the trade I'm taking, if it is a bullish trade or a bearish trade. Then we have something called breakup block. What are breakup blocks? Okay, in the breakup blocks, we can have the two lines which we can identify. You will know how to identify them by backtesting these concepts. We have anticipated bearish institutional reference point, is also the resistance level, and we have the anticipated bullish institutional reference point, which is also called the support level. Okay guys, I will leave it here to the illustration here. We have more concepts on order blocks, and if you want these notes, you can always inbox me. I will only take a little fee for it to compensate at least for the effort I've put to summarize for you the notes if you're interested, and if not, it's always good. And I will always come here and put some of my notes and live trades of the notes as well. So remember to subscribe, remember to like the video, remember to comment and share. Show some love guys. Until then, let's see you in the next one. Bye bye.